Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast. Our guest today is Andrew White. Andrew is the founder and CEO of fundapps, a regulatory technology company founded exactly 10 years ago. So happy birthday, Andrew, and fundapps. He completely bootstrapped fundapps and grew it from a small startup to over 60 people and $9 trillion in monitored client assets. The company provides shareholder disclosure software to hedge funds, sovereign wealth funds, and other asset owners and asset managers. Before founding fundapps, Andrew was a managing director at Aquin Components, a company that was acquired by State Street. We start off our conversation by Andrew walking us through the space of regulation technology, or in short, RegTech. He gives us a history of the space and how the regulation technology industry changed over the last years. We talk about difficulties in adhering to all regulations globally as a hedge fund or asset owner. This episode shows me again why I love doing this podcast, because we start off in RegTech and then take an unforeseen but interesting turn, and Andrew just gives us a masterclass in the art of bootstrapping, meaning getting your startup off the ground without taking external capital. And Andrew shares with us tips about focus, culture, and much more. So if you like this episode, please do leave us a 5-star review on Apple Podcasts or wherever you get your podcasts from. And now, without further ado, our interview with Andrew White. Andrew, hello to the Wall Street Lab podcast. I'm excited to have you on the show.
Thanks very much for having me, Andreas. Very excited to be here.
So, can you tell us what is it that you do? What's your background?
In a very high-level overview, fundapps provides compliance as a service to financial institutions, mainly asset managers, hedge funds, etc. Rather than they themselves having to either code software or to write Excel macros, they send us the data to fundapps, and we will then process the data with whatever regulations they want to ensure they're upholding, and then we'll tell them if they're breaching any rules or if they need to make any disclosures to regulators across the globe. In a nutshell, outsource compliance.
And you are the founder and current CEO of the company, right? When did you start the company and how did you come up with the idea for it?
Current founder CEO, founded in September 2010. We're coming up to our 10th birthday. Happy birthday to us in lockdown. And a very simple background to the company, which I think most companies that do have a fairly resounding motto, they've done this before or they've had experience in solving the problem. Very simply, I was working for a German software company based in Frankfurt. We solved compliance for our customers back then, but the biggest problem was that it was on-premise software. The rules had to be coded by the client themselves. Basically, we would sell a rules engine, but the client would then have to code all the regulations, stay up to date with the regulations. And I thought to myself, well, this cloud is coming, or the modern technology is coming back in 2010. If I was able to put the software on the cloud, then I could also hire a team of compliance and legal experts that could then code the regulations. The customer could then use the service rather than do everything themselves. And it's a very old motto in SaaS, but if you want a glass of milk, you don't buy a cow. And this was the old way, was you had to buy the cow in the farm, whereas the modern way is I want the service, I just want the glass of milk. I thought, okay, fundapps can just provide the compliance service rather than the software.
You've basically been what nowadays is called the new trend of RegTech, regulation technology. Can you give us a brief history, or maybe start with what is regulation technology? How would you define it in a very broad sense? And then how did it develop over time?
I think RegTech in the current sense, the majority sense, is to do with financial regulation. There might be some RegTechs that do regulation to do with pharma or biotechnology, but for the majority it is to do with financial regulation. And I think most importantly, it came after what the current wave of fintech. If you think fintech's been around for a while, theoretically, all the software vendors that have provided software to banks over the years, the current wave of fintech maybe since 2010, but fintech was a lot of B2C things like TransferWise or Monzo or any of the kind of consumer financial stuff that was relatively easy to implement. Whereas RegTech obviously isn't what it says on the tin, it is solving regulatory problems via technology for clients. It took a lot longer to start because basically you needed a lot of experience in the industry. Certainly, you didn't leave college and understand how financial regulation worked, whereas you might understand how transferring money from Poland to England works, or you might understand how a current account works. RegTech required a little bit more expertise. Generally, a smaller subsection of fintech at the moment, but I would say growing because over the last few years, the amount of regulation and the complexity of regulation has increased. Previously, if you looked at a job board for asset managers, and maybe 50 or 60% were looking for front office traders and brokers and so on, whereas that's flipped now, and that the majority of jobs are back office compliance, regulation, that kind of thing. Regulation is a massive, massive cost for all these institutions. It's becoming more and more important. And obviously, the regulators are finding more and more people. It's really important that these people make sure they're not breaching any regulations. It's generally gone from a small segment to growing and growing. And I would say now, equally to be fintechs, there's quite a large section of regtechs, but maybe not as well known as the fintechs.
Would you say it also came with a change of mindset? Because I think that banks are very, very sensitive when it comes to their compliance, their regulation, and they often want to have their hand on it. What do you think made them change their mind to outsource this very important part, right, of the technology? Because how can they be sure that you are doing it right? Or can they then say, okay, hey, it was fundapps, it's their fault, I'm just going to put them in the street and let them talk to the regulators?
Yeah, that's a fun one. I mean, I think you're right. It's super important to get right, not only financially for getting penalties, but also your reputation. Obviously, if you see the likes of BlackRock or some of the big asset managers getting fined by regulators, they might be able to afford the fine, but it doesn't look good for them. The real two main reasons that RegTech became that important was just the volume of regulations. A simple example: in Europe, there's a framework for mutual fund compliance. Every mutual fund in Europe has a set of rules that the fund must comply with, and it's called UCITS. And UCITS 1, the very first version, came out in the 80s. UCITS 2 they skipped, but UCITS 3 came out in the late 90s, and then UCITS 4 and UCITS 5 have come out in the last few years. So the velocity of change has just increased, and things where perhaps, if something only changed every 5 years, you could do that in-house. You didn't, you could get a team together to make the new regulation. If the regulation is changing every year or every 6 months, then banks aren't very good at agile, as we know. The ability to put a team together to fix this or to make this new regulation work, or to adopt, to fix it, to make it work with the newest requirements of the regulator, they're good at waterfall. Big project plan, implement, test, works, go live. In this day and age, basically, regulation is changing every couple of days, every couple of weeks. Unless they have a full-time team doing it, they're unable to meet the regulation. And the second is the complexity. The usual thing, the modern world is far more complex than the old worlds. Maybe 10, 15 years ago, the calculation was A plus B divided by C. Now that is a big algorithm, isn't doable in Excel. The original version that was written by some guy 20 years ago no longer works. Basically, the speed of change, but also the complexity of the current requirement and data volume. Things like MiFID 2 require so much more data than MiFID 1. A perfect storm, increasing volume, increasing frequency, increasing fines. And then, as I said, the complexity of it all is a lot more than it used to be. So led people to look for solutions. And then why companies like us have been successful is obviously focus. This is all we do. A bank has 10,000 things to do. Some other software vendors do 50 things, but we just do this one or two things very well. It's a lot easier for us to do this and do it correctly than it is for a bank to do this with 4 or 5 people on a regular basis. It's just this thing of focusing that we all know nowadays, that if you're very good at one thing, you become best of breed, as they say, then if somebody's looking for shareholding disclosure, they Google, they'll find us. And we've obviously 75 clients now. It becomes a very clear strength in numbers. The more clients we have on the platform, the more confidence future prospects will have that this works because 75 other institutions are using it.
It gets a bit of a commodity, right? If you have enough people on the same platform are like, okay, this bank started using the platform. They must have checked it. Let me just check it again. Then the third says, okay, I'll check it, but not that in detail anymore, and so on and so on. From the 10 years in your history, who were the first institutions that were like, okay, I need this technology? And then where do you see your clients coming up now?
That's been very interesting. Our very first client was a smallish hedge fund in London. Our second client was a little bit smaller hedge fund in London. We started off with the smaller institutions that were able to, well, had maybe a higher risk profile. There wasn't this management committee and steering committee decisions, Lenkungsausschuss, as you'd say in German. There was just a very clear, we have this problem. These guys provide a solution. Yes, they're small and young, but we've checked it out. It looks like it works. And then, as you said, the customer 3 was a slightly larger asset manager in the Netherlands, and customer 4 was an investment bank. Basically, as we got more clients on board, we were more acceptable to larger and larger clients. So this day, our clients range from $200 million hedge funds in New York to $500 billion asset managers in the UK to $1 trillion sovereign wealth funds. So basically, the massive, large institutions that do need longer to decide. And that's also, I think, is an important thing about if you're selling and how to set up a company, then obviously you want to go for the people that can make a decision quickly. Because if you're not getting any cash and you've got a sales cycle that takes a year or 2 years, then that's going to be a lot of time before you see the money. For us, it was clearly going after the smaller to mid-sized institutions that can make decisions more quickly. And then while we were doing those, starting to talk to the bigger institutions, they would then take their year or 2 years to make a decision.
Your target group are asset owners, right? That own the assets and not banks themselves, because they probably have other or different compliance issues.
Asset owners and asset managers, anybody who is managing the equities for somebody else or anybody who owns them themselves. So we do have a very large spectrum of clients. As I said, we do have some very large investment banks in France and Germany and Canada, but the majority of our clients are asset managers and hedge funds, are the asset managers themselves, but we do see more and more asset owners.
What type of hedge funds do use your services? And why do you think that is? Is this high frequency trading hedge funds, or is this more the macroeconomic hedge funds?
That's quite diverse. So our ideal customer is somebody who manages a lot of money. It's quite simple in shareholding disclosure. The more AUM, the more assets you have, the more likely you are to disclose. If you've only got £10 in Microsoft shares, you're never going to have to disclose that ownership. But if you've got $1 trillion or 500 billion, it's very likely. The second factor is, as you said, high frequency. If you only trade every 6 months, it's quite clear there probably won't be many disclosure requirements until you trade again. It's the large volume or large AUM, high frequency traders, also the jurisdictional composition. So if you're only trading German equities, you probably know how to do Germany. For us, we find the clients that are trading in 60, 70, even 80 countries every day. They're shorting stocks in Israel, they're longing stocks in Uruguay, etc. That geographical macro outlook is one of the biggest factors in deciding to use us, because, as I said, to remain up to date with how to disclose in 95 countries on a daily basis is really, really difficult. Those hedge funds, yeah, equity based mainly. We do have a commodities product as well for position limits, for CFTC limits, but the majority are equity based, large AUMs. If they short sell a lot, very relevant to us, because the short selling limits are a lot lower than the long limits. Typically in Europe, if you've got more than 3% of the shares outstanding, there'll be a major threshold, but for short, it's about 0.2. So you could have a small fraction of your positions short, and you would need to disclose a long time before long ownership.
Can you tell us what exactly is shareholder disclosures? What do I have to picture with that?
It's a really simple concept, and I don't know how we've been doing it for 10 years and employ 65 people to do it, but that shows how complicated it is. In a very, very simplified version, it is you as an asset manager need to aggregate all your positions with a certain company together. Let's say you're at DWS in Frankfurt, you have 1,000 funds. Each of those funds holds 1,000 Facebook shares. You need to add those up together. You've got, let's say, 100,000 Facebook shares. Divide that by the total shares that Facebook has globally, which is a couple of billion, and that's your current ownership level of Facebook. So let's say 1%, 2%, 5%, etc. The reason it's important and regulators and companies care about it is obviously they want to know when an investor has suddenly gained 3, 5, 10% ownership of their company. The companies couldn't enforce that themselves. That's why we need regulation to do it. Every country, basically, as I said, 95 countries currently, has some regulation around as soon as you go over a specific threshold, 1%, 3%, 5%, you need to tell the regulator. It looks simply as that DWS would need to tell the SEC, because it's an American stock, American company, we've gone over 5% ownership of Facebook. They'd have to make a disclosure, as we call it, to the SEC saying, hey, yesterday we had 4.9% of Facebook, today we own 5.1. We've gone across the 5% threshold and we have to disclose that. The fun part about this is the percentages are different in every country on the planet. Some countries it's 1%, some countries it's 2%, some it's 1, 2, 3, 4, 5, 6, all the way up, some it's 5, 10, 15. How you calculate that is different. Some countries care about the shares in treasury. Some care about voting control. Maybe there's different share classes and they don't care if the share class has no voting control. It's about how many votes you exercise. As I said, every country can decide how to do the calculation, how to define the algorithm. What we do is then per country model the algorithm, the percentages, the calculation, how to do the denominator and the numerator. And then obviously our clients then send us their data on a daily basis. And we just compare what do you own today versus what did you own yesterday, and then tell the client if they need to disclose to the regulator.
Why do the regulators want to know? It seems always to be around this 5%. Why do the regulators want to know who owns more than 5% in the company?
There's two answers to that. One is the regulator doesn't really care, but they needed to make the regulations. The issuer would care. Obviously, Facebook cares who owns 5% of them. I, as a company owner, would want to know who owns a large share of fundapps. Basically, transparency. So companies want to know who owns them. And if this requirement wasn't there, then Vanguard and Fidelity and BlackRock could get together and buy every share outstanding of a company and then turn up to a board meeting and say, hey, between us, we own 91% of this company, you're all fired, kind of thing. But it's mainly for the actual companies themselves. And why the percentages, as you said, generally 5%. It's quite simple that the regulators don't want every 0.5% or every 0.1%. So they put it fairly high, so that they only get a few disclosures every day or every year. I think at the end of the day, if the regulator was to use electronic technology, and it's something we can talk about, that the regulators are actually should be the end consumers of our service and not the asset managers, because it's the regulators that want to know this information. That theoretically, if they had access to all the data our asset managers have, they would say there are no percentages, but they can then log in and see every single day what the current percentage ownerships of each country are in their jurisdictions. The BaFin could log in and see the ownership of all asset managers in companies that are German, and they wouldn't have to require a certain percentage.
That makes a lot of sense. I'm reminded of the movie Wall Street with Gordon Gekko, where he does this backdoor trades with people trying to take over companies and doing all that. So I guess where this is coming from. I'm curious now, if one of those high frequency trading hedge funds sends you all their daily trades or all their position data, are they not concerned that now you're going to do your own hedge fund, as an aggregate of all the other best strategies in town and then get their proprietary technology? So we had Greg Zuckerman on the podcast who interviewed Jim Simons, the legendary founder of Renaissance Technology. And they were so secretive about their code and everything. Would they ever give you their trades?
Renaissance isn't a client yet, but we're working on it. I think there's a few things there. Is one, obviously, our internal IT and security protocols are very much set up to stop that happening. Obviously, that's part of our agreement with the client, is that we don't do that. You're right. At the end of the day, it's a trust / that they ensure that our information security policies are strong enough that they believe that, as you said, we're not going to do that. And I think at the end of the day as well, we don't have the algorithms that they're trading on. All we can see is the end of day positions. Why they have those end of day positions is the actual algorithm. We know you've 10,000 Facebook and yesterday you had 7,000 Facebook. Why you made those trades is then the black box. But yeah, you're right. I mean, our biggest impediment to sales is generally the information security, and that clients and prospects can trust that we're not going to run away with their data or sell it on the black market, etc.
You're only looking at end of day data.
Generally, it's, yeah.
Okay, my follow-up question would have been, if I'm a high-frequency trading hedge fund and I have to run every trade through your system, get a green light, and then run it back, I'm basically already too many milliseconds behind what I try to achieve.
Correct. That's very, very true. For our purposes, for shareholding disclosure, it's only an end of day task, and the regulators are explicit about that, because you can imagine if they are thresholds and you're at 4.99 of a company at 9 a.m. and then you buy some shares, you're at 5, and then you go sell them, you have to disclose again. The regulator might get 10 disclosures a day. So they're like, we don't care about intraday, just end of day. There are some regulations, the UCITS regulations, for example, that do require you to do pre-trade checking, which does have a lot of problems with high frequency trading, because as you said, generally it just wouldn't be fast enough to check on a real-time basis.
A fund manager would also be checking out in which jurisdiction can I actually do high frequency trading, and where do I have too many pre-trade checks to actually have my strategy.
Yeah, a general mutual fund in Europe, which obviously isn't going to be HFT, has to do pre-trade checking for UCITS purposes. So they would make sure that every single proposed trade had to go through a compliance engine. Simple checks like, for example, in UCITS, you can't buy gold, you can't buy commodities, you can only own more than less than 10% of one company. So if you've got a portfolio of 100 million, you can invest maximum of 10 million in one company. That all has to be done on a pre-trade basis, which again is sometimes a bit pointless, because at the time you might only have 9.9%, but during the day the percentage or the price of the stock goes up, so that at the end of the day you're actually over the limits. Pre-trade and post-trade are both very important in mutual fund compliance, but pre-trade still requires a lot of work to make it that speedy that HFT could use it.
Let's circle back to what you said earlier when you said that actually the regulator should use your technology. How would this kind of vision look like, and why are they not doing it nowadays?
Here's a funny one that hopefully your listeners will appreciate. Our current, as I said, our users are the asset managers. They discover they need to make a disclosure. They need to tell the BaFin or the FCA or the SEC. Our system will currently generate for about 150 different rules the required documentation. For example, in Germany, that's an XML file. In the UK, that's an Excel sheet. In the USA, it's a text file. And basically, the client then has to email that file to the regulator. And even worse, sometimes on a rule by rule basis, as I said, some countries have long limits and short limits. So the long threshold is 3%, the short threshold is 0.2. For example, in the UK, the FCA requires the long disclosure to be made in a Word document sent to one email address, but the short disclosure needs to be made in an Excel sheet sent to a different email address. So basically, our clients are on a daily basis sending 150, 200 different documents to 200 different email addresses. Each of those documents looks nothing like the others. Some of them are, as I said, tabular, some are formatted nicely, some are XML, which is great because it's structured. But then if you think about what the regulator is doing on the other side, they obviously have some junior, hopefully, who's in the email inbox, saving every disclosure to a drive somewhere or putting it on a stored network drive. Hopefully they do something with the papers or the documents, maybe copying and pasting them into a certain database, but we have to presume that not every regulator can do that. There's probably a large chance that these documents are just being saved and not looked at. As a very long story short, we truly believe that this disclosure is important. There's a reason there's a regulation there, but the current method of asset managers sending their disclosure information to a regulator via email in a document is just really pointless. We'd love to see electronic filing, API filing, that the asset manager can just send the information that's required by the regulator via API. And at the end of the day, if there's an API, then we could also be that platform that there's a read-only section where the right section where the asset manager generates the disclosure or the information, and then there's a kind of read-only place that the regulator could log in and see all the disclosures in their jurisdiction. So it's something we're talking to regulators about. As you said, it's not easy to persuade them because obviously they're not the most technology savvy companies. It's hard for a regulator to hire lots of techies to build this. We're trying to talk to them and mention structured data and how they could take XMLs or APIs rather than accepting PDFs.
A curious thing that I was pondering about while I was preparing for this episode is, you talk to so many different regulators, probably all around the world. And now with what you just said, Is there a bias? Are any kind of regulators more tech savvy than others? So background is I lived 2 years in Singapore, and I always had, from talking to banks there, I always had the feeling that the regulators is really up to date compared to countries like Germany, where they're not often so deep in the weeds as, for example, in Singapore. Do you see any trends or any obvious differences in the advancement of the regulations?
Absolutely, 100%. You've named the MAS in Singapore as one of the most forward-looking one. And as an example, we do currently support API filing, so those most sophisticated regulators that have an API in a structured format. And currently the most unsophisticated, no names mentioned, but it is a Eastern European regulator where they still require a fax to be sent. And actually some Far East regulators as well still require letters to be sent. And there was a very interesting regulation update 2 weeks ago from one of these regulators that said for the period of COVID-19, it was acceptable to send email rather than send a letter. And this was just for COVID. They were going to revert back to letters after COVID. But long story short, there is everything from API to fax to letters. You mentioned BaFin in Germany. Actually, they are one of the most advanced. That they are one of the few that accepts API filings and XML filings rather than documents. But it is generally to do with size of the marketplace. So the UK, the FCA is also a very advanced regulator, as is the BaFin, as is the MAS. The ASIC in Australia is quite advanced too. They allow electronic filing of CSV files rather than Excel sheets, etc. So it really depends on the size of the jurisdiction and how much the country obviously invests in the regulator, because it has to be funded by the government. The SEC in the US is a bit behind the times. They still publish information in PDFs and require things to be sent in HTML and stuff like that. But again, a very big regulator that probably has a lot of legacy that needs to be changed over the years. You do see some of the larger European ones and some of the smaller ones that have maybe less legacy to deal with, like the Baltics, etc., that have jumped the shark and gone straight to API filing or straight to more structured data rather than PDFs and faxes.
If I want to hire your company to do some filings in the Far East, then you have to have a stamp postage increase on the monthly license. That's
well, exactly. If we were to do the perfect service, then I guess there would be a please lick the stamp for me button, and then somebody in fundapps would then obviously have to print out the letter, put it in an envelope and send it off for the client. But currently they have to do it themselves.
Okay, this is something you're like, okay, this is just, it's not that scalable as a company.
Not the scalable. We'll create the Word document for you, but it's up to you to print it out and send it. Yeah.
Okay, good time. So we know where the next market opportunity for anybody that wants to be in these sending letters to the regulators business. That's really interesting. And talking about trends, what do you see in the next 5 to 10 years in the market? Where are things going?
Yeah, I think we've just literally started talking about it. I think that's the automation is step one, and I'm very glad that all our clients and prospects have seen that automation is the way to go. 5, 7 years ago, it was still hire lots of graduates, put them in front of Excel sheets. If you've got more data, then hire more graduates, clients, associates who have to type in macros and run things manually, etc. Fortunately, and hopefully fortunately out of COVID, that people have realized that manual solutions, and especially those solutions that are tied to you being in the office, and we do have a few prospects that literally had Excel sheets that needed to be run manually, and either they don't work via VPN or it doesn't work as well as it does in the office, that you see a lot of worst case scenarios. Either somebody got sick or the file couldn't be run. We see that automation is the acknowledgement that automation is the only way forward is the first step. Doing something manually or using people to run macros or to manually do stuff in spreadsheets is not a long-term solution as these companies grow. And we're, as I said, we're seeing that slowly but surely. Our 75 clients have obviously seen the light early and that realize that automation is the answer. The second is obviously then how do you increase that automation? So we say in a sales demo that we bring you 95, 97, 98% of the way there. We will do the calculations. We will tell you need to disclose. We will create the document that you need to send. We'll even pop open an email that you need to then click send on. But at the end of the day, that the full automation for our clients, and particularly talking about fundapps, is literally that they get an Alexa message or Siri message saying, "Good morning, Andreas. I've made 37 filings for you today. You don't need to go to work today." And that is true automation, and a lot of areas of the world, that would work. We can make self-driving cars. Why do we still need humans to click buttons to make these disclosures? And a lot of that is data quality. Can you trust the data? Garbage in, garbage out. A lot of our users still have to check the data, make sure it's okay, and we're helping them with that. We've got a lot of new features to do with verifying that data is correct or pointing out to users that this data might be wrong. And the second is then, as I said, automating the full disclosure process. We can send the data that the regulator requires straight from our system to the regulator, get acknowledgement from the regulator that they've seen it, goes back into our systems. Hopefully your job is reduced to just reviewing that the job has been done for today. It's just automation and then getting towards 100% automation. That in a lot of industries is the case. A lot of industries that have been using technology for longer, it's normal that everything is automated and that humans don't have to do anything.
I want to switch gears a bit and talk more about the entrepreneurial side. So you've been founding fundapps 10 years ago. You are still the CEO, you're still growing pretty rapidly, and you've entirely bootstrapped. For listeners, bootstrapping means you haven't taken no external capital. How do you think you could achieve that? Nowadays, it's all about VC getting to San Francisco, going to Silicon Valley, get the biggest VC you can find on your board and have them give you 10 million euros, and then you just go out and try to find clients with a burn rate that's just insane. You're like kind of the exception there. Why did you decide to do that? And why did you think you pulled it off?
Lovely questions. I hope I have a good answer. I think the good thing about B2B is that generally it's very sticky. If you get a financial institution, a bank, an asset manager using you, unless you screw up really badly or your system's terrible or it doesn't do what it says, there's really no reason they would leave you unless a competitor comes out and is 50% cheaper, 100% cheaper. Even then, they'd have to make a big decision. So if you can get into an institution, your revenue is fairly secure, even in times like these. I think the B2B model can be very nice for young companies because, as I said, you're selling to institutions that generally have more money than consumer. Rather than selling something at £3 or $9.99, you're selling something with a 5 or 6 digit price tag. So for us, it was very simple. We built a product. I think myself, having a few gray hairs, having spent my 5 years in Frankfurt, etc., building experience, I had a very clear idea of what I wanted to do. It was very much the product market fit was there from day one. That sounds a bit cocky, but it's not like B2C or other areas of B2B where you're not sure if there's a market. This is RegTech. This is a regulation. This needs to be done. There isn't an option for the asset manager to do it or not do it. They have to do it. So basically, if we talk to an asset manager, we knew they were either doing this currently or we're doing it well or we're doing it badly. I think regulation, RegTech is a fantastic area because you know everybody has the problem. I knew what the solution was or believed it was. I think the issues were then cloud and for a big financial institution to trust a small or young company. But then it was very much a snowball effect of, okay, first client signed, you've got £100,000 in the bank that can hire 1 or 2 or 3 people. You build some more software, your burn rate is still above zero, so you're making money. So then, when client 2 comes along, you make more money, etc. So for us, it was just very old school fiscal prudency. You don't spend more money than you have. You keep building on the product even when you've got no client signing. It's a 9.5 years, somebody says 9.5 years overnight success, but it is a longer play. Sure, if we'd have taken 10 million from day one and hired 50 developers and built the software, we might be where we are now or further. But there's a lot of risks involved in that. You risk building the wrong thing. You risk throwing money at stupid problems. If you just said, hey, let's investigate this idea, let's take 2 million and spend on it. You do a lot of stuff that perhaps in your heart aren't the best of ideas. So I think it encourages a certain discipline in the product process, in the sales process, that you know what you have, you know what it does well, and you just focus on that. And that's something for me is very important for entrepreneurs to focus on one thing. The Facebooks and the Twitters and all these guys, even though they do a lot of things now, when they started off, it was very clear this does one thing, it connects friends or lets you tweet. And it's the companies that try and do too many things at once that fail. For me, focus and a little bit of, shall we say, patience and knowing that in the long term it'll work out, combined with a B2B play where once you win a customer, it's there for many years to come. is a very nice way to build a company. And obviously, as you said, we've got great Glassdoor reviews, etc., we can create a culture that isn't around hire, 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 fire, fire. It's about building up a culture over years that people enjoy working here and that they know what we're building and why. And it's not about just ramp it up and sell it off and buy Ferraris, etc.
How do you create a good culture?
I think going back to what I said, having clear company values about why you do things. I mean, I think, and going back to money and the root of all evil, but I think if you had a VC on board, for example, and it's, let's say, December and you're 300,000 pounds behind target, and a prospect comes along and says, hey, we would like you to make us a toothpaste widget. And you're like, well, we don't do toothpaste, we do shareholder disclosure. They're like, well, yeah, sure, but it's $300,000. If you're a VC-backed company, you're probably going to make that call because you have to hit target, because blah, 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 so many other things are dependent on your revenue numbers, that you would make that decision. And, there's no reason why a shareholder disclosure should make toothpaste, or use a different metaphor. For a lot of short-term gains, bad long-term decisions are made. And obviously, if we'd have decided to chase every revenue opportunity over the years just to hit certain numbers, arbitrary numbers that a VC had given us, we would have built a lot of shit software over the year, and we would have built a lot of things that only one customer wanted. The usual thing, a product company should build something that all the customers want, not just one customer wants. So again, that's what I see a lot of companies do badly, and that creates friction in the company. Imagine you've got developers working on something that's really cool and fun, and then you say, hey, all developers stop, we're building this toothpaste widget now. And they're like, what, toothpaste? Why are you making this decision? Or, I thought we were building shareholder disclosure. You're like, yeah, but we'll do this and then we'll go back to that because we need to make some money. Long story short, a lot of bad long-term decisions are made for short-term gain that I was able to say no to because we weren't bootstrapped. And if we failed to hit our sales number, I felt bad and the sales team felt bad. But at the end of the day, nobody was fired, and it was okay because we consciously made the decision that we don't want this revenue because it's bad revenue. And that's something that's very clear. There is such thing as bad revenue.
How did you stay away from it? I feel like on the one hand, I totally get your argument. If you have a VC and the VC gives you a number and only then you maybe even get your salary or your bonus for the year as a founder, CEO, whatever. But on the other side, if you're bootstrapped, you're like, well, I don't have another 10 million that I can burn through. I need this revenue. I need this toothpaste revenue. Otherwise, I don't know when my next client's going to come. How did you manage to stay on track? How did you focus? Did you have a big sign on your walls like, don't do bad revenue? Or what kept you focused?
It was more simple than that. I mean, the not making bad decisions was always down to, or bad revenue decisions down to me. But I think, as I said, that the main one was always never burning cash. So as I said, client one brought us X thousand pounds of revenue and our spend was X thousand minus five. And every time we signed a client, we hired or we invested, but it was always below it. So our revenue always went up more than our costs went up. We were never in a scenario, and of course, the very early days up until 2012. So for about 2 years, I obviously didn't pay myself a salary. I just moved in with friends and family and sofa surfed and whatever and ate lots of cheap foods till the company was generating revenue. I didn't take a salary, etc. And then the first customer, as I said, brought us more revenue than the first developer salary. And that always meant that we didn't have to make uncomfortable decisions. If we ever did make a decision, it was purely because our aspiration was to grow and to be bigger. But at the end of the day, it was never that if we don't make this sale or we don't get this revenue, then we're going to have to fire somebody or we're going to have to do something else. Again, back to normal old school business, the way thousands of years worked, that you don't spend more money than you have unless you take a loan, and then it should be short term to do something particular. But in that respect, it gave us a fairly easy decision that we were able to always say no to revenue just because we were still making a profit, even if a very, very small profit.
As there's so much literature on how to get VC money and then how to blitz scale. I mean, there's great books, don't get me wrong, like 0 to 1 is great books. But do you have any tips on people that want to maybe bootstrap their own company? Any literature, any resources that you can recommend?
You're absolutely right. It's strange that an industry that makes profit off making people take VC funding, there's lots of books, but where nobody profits, like bootstrapping, there's very few books. That's exactly the problem as well, that obviously VCs spread the gospel of you need VC money to do well, and every good company has taken VC funding. But there are lots and lots of counter examples, and those that maybe didn't do it the normal way, that took later round of funding or used it to buy out old founders or to take secondary funding. My favorite example is Basecamp, the American kind of productivity platform. I think they had a small investment from Jeff Bezos personally early on, but since then have taken no funding. They've got an amazing culture. They're the guys that wrote the book Remote, lots of other books on how it doesn't have to be crazy at work and stuff like that. They have 4-day work weeks in summer. There's profit sharing schemes. It's just built to last, the company. And I think that's the big difference between Bootstrap at VC. Bootstrap, nobody expects to exit in a year or two and retire. Whereas VC, I think there's still this mindset of, as you said, blitzscale, make loads of money, exit, do something else or whatever. To those that are maybe contemplating doing something, I think we all agreed. There's many philosophers and travel writers that always say that it's not about the destination, it's about the journey. And sure, to make lots of money is fantastic, but if you don't enjoy doing it, or you have to make a lot of horrible decisions along the way, or do lots of stuff that is against your character, your moral fiber, then maybe it's better to do it the slower way, where you can make good decisions and long-term decisions and treat your workforce well, and then hopefully still someday either have an exit or just lifestyle business. That's the funny thing, that the word lifestyle business is always taken to be a really bad thing in Silicon Valley. That's the worst thing you can do, but you've got one life to live as well. You got to decide what you want to do, and if that's serial entrepreneur and do 10 startups in your life, then probably you need to do VC. If you do want to do 2 or 3 startups, then you probably got enough time to bootstrap. I'd say for those looking, look at the books from Basecamp authors on bootstrapping and Google it. As I said, it's not an industry, it's just people that have done it successfully.
You said it sounded very in the thought of greater good. And I found actually on your LinkedIn that you did something like Founders Pledge. Could you tell us, if you feel comfortable, what it is and why you did it?
Yeah, absolutely. I mean, without getting too deep here, because it's a show about fintech and regtech, I truly believe that one of the worst problems in modern society is that companies have no moral fiber. People that work in the company are humans with feelings and morals, but the company itself doesn't need to have any. A company is just a profit-making vehicle. You can burn down the Amazon, you can chop down the rainforest, you can emit CO2, you can have oil spills and whatever, because the company's making a profit. And I think that 90% of employees don't believe that, but somehow companies manage to get away with that. There's 2 things here. One is, as a company, fundapps is a B Corp. B Corp is simply a company that believes there, or has agreed that there is something other than profitability and shareholder value. And it means giving back to your workforce, giving back to the community, environmental, just basically making sure you're a sustainable company. You're not using minimum wage labor, you're not abusing young workers in Asia or paying people below market. And of course, that you're not polluting the environment. That was the first step. fundapps became a B Corp about 3 years ago, and it's something I truly believe in, because, as I said, I think everybody nowadays is looking for a higher purpose and not just making profit and whatever. We want to see that the world is a better place after we leave it. That's the B Corp. And the Founders Pledge is something very similar, that I believe, as hopefully my success at fundapps should breed greater good than just making the shareholders more wealthy. It is that I've pledged to give a certain percentage of the exit value to charity. It's a good system because you can start with as little as 2%, but you can only increase it over the years. So every year you go 2, 3, 4, 5, and it can never go down again. So basically, you give that percentage of your proceeds out of an exit back to a charity. It's very simple for you to sign up to. It's a 1-page document. And it was something I did early on in fundapps that I didn't have to think about. And now, obviously, as the company's more valuable, it's going to mean a greater amount to the eventual charities. And as I said, for me to manually look for charities out there and decide which ones to pledge to and so on would be quite tricky and take up a lot of my time. Whereas this way, it was just a simple document that I had to sign.
I love it. It's really inspiring. I want to use the last couple of minutes to get some career advice from you, because another very interesting thing that I've actually never seen before on any LinkedIn profile was that you were very open about your travel years. You took 2, let's call them gap years, and you just put them out there. Why did you decide to do that? And do you think it hindered you in any way when doing things? Or, as many of our listeners are graduates, young professionals, should they be vocal about it because it makes them more interesting or more open-minded? Or would you actually, as a CEO, somebody that is hiring, be like, well, don't you have anything productive to do?
Wow, there's a lot of questions there to unpack. I certainly think that travel is one of the best and quickest way to broaden the mind. I think if you've stayed in your hometown all your life and never left it, you're probably going to have fairly, I won't say narrow-minded, but haven't seen certain things. And for me, I first did a year-long travel in 2003. For me, the first dawning and first mind-blowing thing, which to this day stood with me, was I'd been living in Frankfurt. I was on a six-figure salary. I had a penthouse apartment in Frankfurt, happy days. By all intents and purposes, for most of your graduates, I was living the life, tick box, tick box, tick box. But I was unhappy. I'd been in a relationship, I'd broken up, I didn't enjoy my job, there was lots of stuff going on. But as I said, I had a full fridge, a beer cellar, and wine cellar, etc. And I was unhappy. And then I got on a plane, I was in Thailand for a few weeks, and then I went to Cambodia. And I remember being in Cambodia and I was on a boat somewhere in the middle of nowhere and I saw a few kids playing by the side of the river. I've never seen such happy kids in my life, not in Frankfurt, not in London. They were smiling, they were waving, and they were playing with a bucket. I was 30 years of age at the time. My perception of wealth and happiness suddenly fell apart because I realized that money, these kids were happier than any kid I'd seen in a long time, and they didn't have, for Western purposes, any money, but they were very, very happy. They had time. Their grandparents were there on the banks of the river with them, spending time with them, their parents, etc., etc. So that's when things started to unravel for me, and then, or ravel, depending on how you see it. And I decided, okay, wow, maybe how I saw life wasn't the way it probably actually is. And hence what for travel for me is always that, just seeing how other people live, how you can be happy without a Mercedes or without a big apartment or whatever. And I think over the years I've realized, and maybe it's not what you see when you're traveling, but talking to different people. Hence, why meeting other cultures and talking to people, getting different viewpoints on something for fundapps is very important, is diversity. We're not looking for MIT or Stanford or Oxford students. We want people with no college backgrounds, older, younger, male, female, because at the end of the day, diversity of thought is what makes good solutions. If everybody thinks the same way, you'll make the same mistakes. Long story short, I believe travel is very, very important. I also want to show that you shouldn't be embarrassed about putting it on LinkedIn. I think going back to the twice that I've done it, the first time I did it, I was hired back by the VCs of my old company into an even better job to sell the company. So actually, the travel for a year paid off in a few weeks, and I had an even better job. I use the word better in apostrophes, but I went on to be successful. And likewise, when I came back from my last long trip of a year, I went on to set up fundapps because I realized over the year that I didn't really want to work for another company again and decided to set it up. If there's any kind of nugget of truth, I believe you should go out there and do it. I think we're all going to retire later and later in life. Might have been 65 at some stage. It's probably going to be 70 soon and 75. We're all going to live longer. So you've got a very long career, unless you plan to start a startup and get VC funding and retire a multimillionaire. For the vast majority of us, we won't. You've got a long career ahead of you. Work out what you want to do. I think people should give things a little bit more time. I think the modern society is very transitory and change and do different stuff, and that's fine if you really hate what you're doing. But sometimes you have to work at something for a while to really understand, do I like this? Do I enjoy it? Because in many complex areas, you can't get an understanding of what you're doing in 6 months or a year. You need to work at it. So I think you got a lot of years in your career, try something out. If you don't enjoy it, try something else. Do a bit of travel if you've got the savings to do it. It's up to you. You've got one life to live. And I think as I said, I don't want people to end up, as I call them, career racehorse that races and races and then realizes they don't want to be racing anymore. Find out what you enjoy doing. Obviously, it's weird times now with COVID and stuff, and getting a job is important, but save your money. Don't spend it all. Be fiscally prudent. Have some savings that if you do decide I want to travel for whether 3 months or 6 months or even 2 weeks, that you can do it and you're not indebted to your job to have to stay there, which we don't want to be. If there's any takeaway, I think go out there and travel and don't worry too much about your resume, because there are CEOs like me that will look fondly upon it. Of course, there are other CEOs that mightn't look fondly upon it, but I think if you've traveled and it hasn't just been getting drunk in Sydney or doing whatever, that you've got something to show for it and you can explain what you learned or how you've changed, then it's always a positive thing.
I really hope that inspires people to not only look at their professional CV, but only their life CV. I have this exact same experience. I've traveled a lot in my years when I was studied in Asia, and it really made me a better person, I would believe. I fully agree. I'm already inspired. I will definitely put my travels into my LinkedIn profile after we hang up. And I think, Andrew, that's been fantastic. I started talking about RegTech and now I got a masterclass in bootstrapping and amazing career advice. Andrew, do you have any last words that you want to share with our audience? Anything that we didn't cover yet in this amazing conversation?
Yeah, it has been a wide-ranging, as you said, from deepest, darkest regulatory technology through to the purpose of a company in the 21st century, through to your personal career plan. And it's not just working. We've kind of got to the most important parts of it. You've got one life to live. You should do something you enjoy. I think too many people stick with, and especially in Germany, I know the culture quite well, sticking with a job because it's got a good Deutsche Bank or it's got a good label or, your parents feel good about it. Those days are ending. The banks aren't secure employers anymore. You need to find something you enjoy doing and give it your best shot. And that could mean bootstrapping your own company. It could mean working for a startup. It could mean working for a bank for a few years. Because to be honest, if people have worked for a bank, they learn a lot, whether it's stuff that they don't want to do again or do want to do again. Be more intent to experiment with things. Don't be too worried. Life works out. Here I am, age 40 something, a CEO and founder. I couldn't get a job when I left university because the market wasn't great. Have patience. Things will work out for you.
Perfect. This is what I love about this podcast, exactly those conversations, starting RegTech, ending amazing life advice. I think this is a good place to end this, and I look forward to stay in touch to have another conversation. And Andrew, thank you so much again in my name and the name of our listeners, and all the best.
Thank you very much, Andreas.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.